To our live podcast today. We're going to be talking about investing. So I'll give you a little bit of my background. I'm actually mutual fund license and insurance license. So I've been doing that since I was 18, right? So I'm excited to talk about this, and hopefully you guys have some questions. And I'll introduce the rest of the hosts today. Carlos here.
Hey everyone, nice to see you again. Nice to be here. I know I'm going to learn a lot today, so I'm super excited.
And then we have Hunyah and Jessenia here as well.
Hi everyone.
Hi.
Nice to see you all. Really excited for today's presentation. And yeah, I know I'm going to learn a lot as well.
Yeah, I'm looking forward to see what's in this presentation. Hopefully you learn something new.
Yeah, for sure. I guarantee that you guys will learn something new. So can you guys see my screen?
Yep.
Okay.
Got it.
So let's get started, guys. Investing. So when we talk about the word investing, what comes up to your guys' mind? Saving money?
Saving money, spending money, losing money.
Yeah.
Growing money.
Yeah. Growing money, yeah.
Putting
What do you
your
guys
money
get out
into
of
something
Do you
like a
guys have any
mortgage.
experience with investing?
You know, I messed around a little bit on Wealthsimple for a while.
Nice. Yeah.
I was taking my mining profits that I had from mining Bitcoin and then transferring that into my Wealthsimple account and messing around with a bunch of different stocks. But mind you, I'd only play with like the meme stocks. I was doing AMC for quite some time and a couple of the other ones, but that's generally it. I was just messing around with things.
Okay. That's good. It's not bad. That's somewhere to get started, right? At least you want to learn about it.
So mine was more probably the opposite end, more of like a stable, like I opened up a TFSA when I turned 18. And then just doing like, bank stocks and blue chip mostly. So
nice. That's good. Yeah, we're going to be talking about stuff today. So let's get started. Typically for most Canadians and a lot of young people, there's three types of accounts that we need. So I'm not just going to be talking about investing. I'm going to do a little bit both about finance as well. Do you guys know what are the three types of accounts that most Canadians need, but they don't have?
I feel like this is a trick question.
there should be a savings one, right?
Okay, savings one. Okay.
Yeah, savings
Checking?
is definitely one.
Savings, checking. Okay.
Checking, investing.
All right,
Like a
we'll
TFSA,
take a look and then see how close you guys were. Okay.
Okay.
So the first type of account that you need is what I say an emergency fund, right? So it's really an emergency account or an emergency fund. So why do you need this type of account is the question you should ask yourself, right? Because the number one reason you need this type of account is for short-term emergencies. For example, let's say if you're driving, your car broke down, right? And you have no money saved. What do you think is going to happen? You're going to take money out of your credit card, right? And that's how you get into debt. There's a big study showing that most Canadians don't have an emergency fund, and that's a really big struggle, right? So the number one account that you need in your life is an emergency account. And if you don't have one, just open up an emergency account in your bank account. It could be a savings or a checking account. Put some extra money in there, right? Number two, short-term savings, right? So when short-term savings come to your mind, what do you guys think about?
I'm actually confused by this.
You're confused. Okay. You're a little confused? What are you confused about?
Well, short-term savings. Like that seems like I think savings of being long-term.
Okay. Why do you think that?
Because you add to it. Sorry, go ahead.
Sorry, go ahead. No, I keep cutting you off. Go ahead. Sorry.
No, I think like if the whole idea and concept for me is that I'm putting a little bit into it, and over time, over a long period of time, those savings will add up and continue to add up.
So usually what we mean in the financial world as short-term savings is usually about 3 to 4 years, right?
Okay.
And then there's what we call, I'll show the next account as well, is long-term savings. That's a little bit like longer, like 7 to 8 years. So why do you need short-term savings? It's usually for stuff like if you were planning to go on a vacation, right? If you're an immigrant, we usually go back to our country like every few years, right? So instead of using your credit card or borrowing money, we recommend that you open up a short-term savings account. Does that kind of clear things up?
Okay. Yeah. Understood.
Yeah, so that's the main reason for that is we want to stay away from using our credit card and getting into a lot of debt, right? I'm not saying don't use your credit card. There's a way to use it, but most people, they don't take advantage of using it right? And then what do you guys think long-term savings is?
This would be for like your retirement, for, I guess even buying a house like in the future, like 10, 20 years, for example, if you're young, things like that.
Yeah, so for long-term savings is usually to buying a house and really not to buying a house, sorry, for retirement and funding your investments. So that's kind of what you were talking about, Carlo. That's what we say long-term savings. Mm-hmm. So let's dive more into, investments and really long-term investing. I'm going to show you guys a concept called use time and consistency. Okay. So have you guys ever heard of the rule of 72?
No,
I have not. So this is something you guys are going to learn today, and everybody who's watching, this is probably one of the most interesting things I learned while I was doing this, right? So the rule of 72, what it does, it tells you how interest really works and how our savings work. Let me ask you guys, if you were to open up a savings account at the bank, what type of interest would you get? Like a high interest savings account. Have you guys seen the billboards?
It's very low, like 0 point something.
Yeah,
like a decimal point. Yeah, exactly.
Yeah, usually about 2 to 3%.
Yeah.
Right? So what does that really mean? Because most of us, when we think we get 3%, that we feel like we're doing great because other people get like 1%. Right? So I'm going to teach you today how to calculate how fast our money grows, right? For something called compound interest. Mm-hmm. So what you do is you take 72, right? And you divide it by the interest rate, and it tells you how fast your money will double. So for example, let's say you went to your bank, right? And you open up a high interest savings account. Usually they give you like 1%, right? And you put $10,000 in there. How long does it take for it to double? So that's what we're going to see today. But for example, let's just say we get 3% at the bank. So if you take $10,000 today and put it in your high interest savings account at 3%, it would take 24 years for that $10,000 to become $24,000. I mean, $20,000, right? What do you guys think about that?
It's a long time.
It's a long time. It's not ideal. Yeah.
It's definitely not ideal. And if you started this as a baby at age 48, you would have $40,000. Can you retire on that?
No.
Right? And most people, they don't even get 3%. They get 1%. So if you do 72 divided by 1, it takes 72 years. Right? So for example, every month, let's say, Carlo, you're putting in $100 into your savings account in the bank. Right?
Yeah.
And then it's averaging 1%. That for that $100 to become to $200, it will take 72 years. Isn't that crazy?
That's a long time.
That's a long time. And nobody ever teaches us this rule. This is actually called the banker's rule, right? Okay. Because if we knew this, guess what? Most of us, we wouldn't be saving at those places for our long-term savings, right? Well, let's say some financial institution, they showed us how to get 6%, right? So 72 divided by 6, it doubles every 12 years. In 48 years, you would have $160,000. So what do you guys think about that?
That's a little better.
It's a little better, right? Yeah. Okay, now I'm going to ask you guys a question, right? If we can average 12%, right, over 72 years, how much do you think the money will be in 48 years? Just take a guess. We'll have 3 guesses from you guys.
I'm sorry, say that one more time for me.
So if you get 12%,
right,
interest rate, at age 48, how much money would be here, or 48 years?
It'll be 4 times the 160,000. Should be right.
How much is that? I'm not really good at mental math like that.
It'll take me a while.
640,000.
Yeah.
Okay. Is that your two's guess?
Sure.
Okay. Hunyah, what do you think?
I feel like it'll be more though. I don't know.
I don't know. Math is not my area.
All right, let's take a look, guys.
Okay.
You guys see that?
Wow.
2.5.
Oh, because of compounding, right?
Compounding interest, guys. 2.5 million.
Wow.
You guys see the difference?
Right.
Now, Carlo, let me ask you this. If you were to retire at age 48, what would be better for you? 40,000 or 2.5 million?
I'm gonna say the 2.5 million, Ruben.
2.5 million, right? But
Yeah.
most people, they would say, man, 12% is impossible. Right? There's no way that I can average that over, a long period of time. Well, that's not true, guys, right? We all know one thing that's been charging us more than 12%. Do you guys know what that is?
No, I don't.
Our credit cards.
Okay.
Right? Do you guys have a credit card?
Yeah.
Okay. Do you guys know what the interest rate in your credit card is?
Not off the top of my head. No.
Mine is about 10%, I think.
10%. Well, that's really good. Yeah. Most credit cards in Canada is about 20%, right? You guys can take a look, call your bank, take a look. Okay. But average credit card is about 20%. So imagine this. Most of us as kids, sometimes when we don't have money, we use our credit cards, right? If we use a rule of 72, we borrow like $10,000, let's say, for something. In about 3 years, I think it's 3 years, right? Yeah, about 3 years, that will become $20,000, right? So the bank they're very smart, right? They use credit cards, right? They take your money, they loan it out to people using credit cards and mortgage. They make a ton of money and they give you the 3%. Right. Does that make sense? So that's the bank's business. No bank will ever make you rich just by saving money in it. Yeah. Right? So I'll show you guys some tactics and ways that you can invest and you guys can save money and potentially earn close to here. Right? So you guys have any questions about this?
No, I think that totally makes sense. Yeah, it's just more about getting closer to that 6 to 12% range.
Exactly.
For most people. Yeah.
Exactly. Yeah. So guys, this is another thing. It pays to start early, right? Look at this. A one-time investment of $1,000 at 9% interest rate, right? Oh, sorry. Accumulated by age 67 at birth. So imagine when you were born, your parents just put $1,000 and said, don't touch this till you're 67. And it averaged 9%, right? It's actually possible. There's a lot of stuff that's done that. If you guys know S&P 500, do you guys know what that is? Yeah. Yeah, it's average, I think, 10 or 12%, if I'm correct. Yeah. Around there, right? So look at this. At age 67, you would have $406,000. Isn't that crazy? Yeah. Right? But if you only started this at age 60, just putting $1,000, it will only be $96,000. Right? And if you wait till age 40, it'll only be what?
Yeah, $11,000.
$11,000. So you guys, this is why money and time is so important. It's so important for us to start investing while we're younger, right? See, most of us, people our age, they think, you know what, I'm not going to invest till I'm in my 40s. For now, I'm going to have fun, not do that. I'm not going to open up a TFSA or an RSP. But that's not the right way to go. It's so important that we start saving at a younger age, right? So, guys, don't pay the high cost of eating with this. If your goal is to save $500,000 at retirement, right? If you begin today at age 25, you only need to save $89 a month at 9%. That's possible, right? But let's say you waited 10 years, 35. That becomes 224, nearly 2 times more, right? At age 45, it becomes $602, right? That's 7 times more. This is the time at age 45, around there, is when most people start thinking about retirement, right? And at that age, it's very hard for you to save money because guess what? You're most likely going to have kids, a family, a mortgage, right? A lot of expenses. So it's hard for you to save a lot of money, right? And at age 55, guys, if you wait that long, you need to save almost $2,000 a month.
Yeah.
That's almost paying a mortgage, right? So this is why it's so important to save while you're young, to invest your money at the right places, and really learn this stuff. It doesn't matter what field you go into, it's really important to learn this stuff, right? So let's go to our next slide here. So look at this, $100 at 9%. We kind of went over this same thing, but this is what it will be. At age 25, it'd be 500. Sorry, at age 67, if you start at age 25, it'd be $566,000, right? 26, it'd be $517,000. It would cost you $49,000 if you waited 1 year, right? And at age 30, just saving $100 at 9%, it would be $357,000. And that would cost you $209,000 because you didn't start again, right? And at age 40, it would only be $137,000. You would pretty much lost $430,000. Carlo, when you see this, what do you really think?
I'm thinking about how I can get to that 9% goal.
Yeah, and I will show you that too later on.
Yeah, that's right? That's I think I'm super curious about. Yeah.
Yeah, for sure.
It's a lot to take in, for sure.
It is a lot to take in.
Yeah.
See, it's so I wish they taught this in school, right, when we're younger, instead of like teaching us those like I don't know if you guys do that in Toronto, but we had this stupid like comms class where you learn about like budgeting, but like you don't learn actual budgeting. They say like it's all approximate, right? But if they really
didn't have that. Wow.
You guys didn't have that?
No.
I had a class like that in high school.
Yeah, we did too here in Alberta, and it was useless. But if they taught us this, man, it'd be like so important for you to save and really learn about it, right? So this is really the power of compound interest. If you're saving $20 a month in 10 years, right, that'll be $3,900. But if it's 100, it's $19,000, right? And this is all at 9%. Oh, sorry. And at 20 years, $20 a month is $13,000. 30 years, $36,000. 40 years, $94,000, right? So it's so important that you value your time, you start saving early, and you value, like, try to put a little bit more, whatever goes with your budget, right? So let's go to next year. So here are the two decisions to make when investing, right? Number one, you need to figure out what type of account you're opening, right? The first type of account there's what's called cash account, right? Cash account is just typically a regular account. The only problem is if the money grows, it's taxable, right? And then there's what's called a TFSA, right? Do you guys know what a TFSA is?
Yeah.
Does everybody here know how it works?
No.
No. I know a little bit about it.
Like a basic overview of it, yeah. Like
okay, I'll give you a really small, like a brief explanation. How TFSA works is very simple. Let's say you put $100 in, right? And that $100 grew to $200. When you withdraw that, you don't have to pay tax. And you don't have to pay tax on the interest. Pretty much, it's tax-free. It's just very simple. Whatever the money you put in, you don't have to pay tax. Whatever the money you put in, and whatever it grows to, whenever you bring it out, you don't have to pay tax.
Pay taxes on it. There's a limit to that, though.
Yeah, the limit. There is a limit. Yeah, it's $6,000. Correct. Yeah, there's a limit of $6,000 a year. Typically, they increase it or decrease it. The government decides, right? Mm-hmm. And then there's an RSP. Do you guys know how an RSP works?
Not as much, no.
It's related to student loans. I actually did once apply for a job like that once. And one of the things was that you have to see is how many people would be interested in investing in their children's loans besides applying for OSAP and all these things.
That's an RESP. That's not an RRSP.
Oh, so, okay.
Yeah, an RESP is a registered education savings plan. It's when your parents, they could start saving money for you when you were a child, right? And the government gives you 20%. And, when you go to university, you know how to take out a loan, right? That's pretty much what an RESP is. But for now, we won't talk about that because most of us, we don't have kids, right? But we'll talk about RSP. That's very important to know. I would, Jessenia, do you know how it works? Have you had experience with it?
No, I haven't.
Okay. So RSP is very good if you have a job and you're paying a lot of taxes, right? So it's also important that you don't just put all your money in RSP, right? The reason is RSP works like this. It's a little bit hard to understand at first, but let's say there's an average Canadian, they make $60,000 a year, right? And let's say they pay tax of, what is the tax bracket of 60,000? Let's say 27%, right? How much is that? Do one of you guys have a calculator?
I can do it.
I can, yeah. Oh.
Yeah, okay. Let's just say 27% is the tax.
So like almost 18,000.
18,000, right? Towards the year, let's say they put in $10,000 into their RSP. So how an RSP works is it's tax deductible, right? So what that means at the end of the year, you get money back from your tax. As in saying, how the calculation is, you take 60,000, you minus it from 10, like minus 10,000, whatever you put into your RSP, right? Does that make sense? I know it's hard to explain without writing.
I think I got it. Yeah.
Okay. So what you would do to figure out how much you get is this. Can you do 50,000 times 27% of tax?
27 still, right?
Yeah, let's just say 27.
Okay. 13,500.
And before it was 18,000, right?
Yeah.
So what you do to figure out how much you get is you go 18,000 minus 13,000, and whatever the rest is how much you get back.
So 4,500. Okay.
Exactly. So at the end of the year, you get 4,500 back into your pocket, and you can use that money to put into your TFSA.
Right.
Right. So RSP is very good if you make high income. But for us, most of us are in university, college. It's not very good because we don't pay a lot of taxes.
So we want to stick to that TFSA for most of us at this point. Right.
Yes. And then later on, when we get jobs, we use RSP. The reason is when you withdraw money, you pay tax.
Right.
Right. So when let's say you're making $60,000 a year, you also withdraw $10,000 a year from the RSP. It's like you're making $70,000 a year.
So, but even on any capital gains, you're still being taxed.
No, you don't pay tax on capital gains because it's still tax sheltered.
Okay.
Right? Only on the withdrawals.
Then.
Yeah. The only way to really take advantage of this is a little bit more complex. Is when you go into retirement, there's ways to withdraw money without paying tax, right? There's at retirement, the maximum amount that Canada doesn't charge tax on is 12 grand a year, I think, right off the top of my head. So the way you do it is you withdraw 12 grand a year from your RSP and then rest from the TFSA and stuff, right?
Okay.
So those are some of the accounts. Then there's RESP, right? That's what we talked about. There's a trust, right? Trust accounts. And then a LIRA. You guys most likely won't know what a LIRA is. That's for pensions, right? So it's called a locked-in retirement account. So those are the type of accounts in Canada, right now. And I know Justin Trudeau, he's talking about the new tax-free savings home buyers plan. It seems very exciting if it does go through. So it's pretty much for young people like us below age 40, where you can save money and you can use that for your first-time home buyers plan, right? And you don't have to pay it back. So maybe that will come in the future. So what type of investments are there? So there's saving accounts. I think most of us, if you have a bank account, we have a savings account, right? And there's a money market. And then there's GICs and term deposit. Do you guys know what a GIC is?
I actually don't.
Okay. It's usually in the bank. My recommendation is stay away from it. It's a really kind of ripoff. It's called guaranteed income certificate. And pretty much your money's locked in and you're guaranteed an interest.
Okay.
Right.
Okay.
But the reason the banks do this is because when your money is locked in, the rule in the bank is they can loan that out for 16 times more. Right. So
it's sort of like a fixed mortgage type of thing.
Kind of, except it's for your savings.
Right. Yeah.
Right?
Your interest rate staying the same.
Interest rate stays the same. So you get a savings every month. But the bank, they use that money. For example, let's say Carlo put $1,000 in a GIC for 5 years. the bank can loan it out for $16,000 to somebody else. Remember the rule of 72, the 12 to 3? It kind of works like that. The bank makes more money out of your money. Does that make sense? I know it's a little bit complicated to understand. No worries though, okay? And then there's bonds. Do you guys know what bonds are?
Yeah.
Okay. Yeah. There's stocks. I think most of us know what a stock is, right? And
Yes.
then there's mutual funds, right? We're going to talk more about mutual funds later. And then there's segregated funds, and then there's also real estate, right? And then there's a lot more investment. But typically, these are the type of investments that you'll deal with in your life. So we have to look at the risk / the return policy, right? So what is the lowest type of risk there is? Go back here. In all of these, right? What do you think the lowest type of risk?
I would say savings account. Yeah.
Yeah, savings account and cash. Because you hold it, it's not going to change. It's always going to be cash. But it also has the lowest return.
Yeah.
Right? Because cash will never get interest and grow. Right? It's like, they say don't hide the money under your blanket or something, right? So, and then there's bonds. See, bonds are what like a government or a corporation borrow from you, right? It's like a bond. They have pretty much a higher interest rate, usually about 4 to 5%, and they have a little bit more guarantee of less risk, right? Usually there's a lot of government bonds where government borrows money from people and then they pay it back with interest. Does that make sense?
Yeah.
Okay. And then there's stocks. So stocks is like, it's a little bit risky and it has the highest risk return potential, right? But you can beat risk with time. I'm going to show you guys that. Sorry, go to the next slide. So this is why I want to talk about mutual funds, because I think, do you guys have any experience with mutual funds?
I don't know.
I once put I had an accident right after college, so I did get I did get a huge check once from the representative that was actually there for my case. And what I did was I actually did receive amount of money, so I did put in the mutual funds for about a year, and I had a good experience with this. But the only thing is I took it out too much, so that's why I was left with nothing by the end of the year. But other than that, that's my only experience with mutual funds, that you just put a huge amount and it grows.
Yeah.
Yeah, and it's less risky too, right? Because you're kind of diversifying your portfolio. So like bonds, stocks, a variety of different things. So
so that's what I want to talk about today. Is remember, Carla, your question was where can I get a little bit higher return and it's 9%, also a little bit safer? It's usually mutual funds. But don't get me wrong, there's a lot of crappy mutual funds, right? And especially banks have a lot of bad mutual funds that don't have a really good interest rate. I will tell you guys later on some mutual fund companies that are really good, right? That you can go see. So what a mutual fund is pretty much where investors pool their money, right? So professional money managers, they put their money in and they invest it. So in like a pool of assets. So for example, if you were going to buy an Amazon stock today, how much would it cost? $1,000.
Amazon what?
Amazon stock.
Okay.
Right? Like one stock would cost you $1,000.
Yeah.
Right? But in a mutual fund, you can invest in that with other investors as little as like $25 a month.
Right.
And what happens is, see, you, the individual investor, you invest to what's called the pooled assets. And then in the mutual fund, they usually have like a team that manages the money and they decide where to invest. They invest it in a global economy, usually companies, right? So it's very diversified. Mutual funds have stocks, bonds, usually all mutual funds have cash as well. And usually they give you some sort of return every year, right? So this is the safest type of investment there that you can do, right? That has return. Obviously, there is mutual fund that's more risky, like all in just one type of class, like oil sector, right? Those are more risky, right? But typical mutual funds are much safer.
So the Amazon stock itself, like I just have it pulled up here because I use Yahoo Finance.
Yeah.
I'm not sure if we use I use the Yahoo Finance to check the markets on what the prices are for the stocks. And Amazon is sitting at 32.23 after hours.
Wow.
So that's the price of one, correct? Like one
Correct.
stock in Amazon. So
yeah. If Amazon ever goes bankrupt, which I don't think they will, you lose all your money.
Right.
Whereas in a mutual fund, if you had Amazon in there but completely goes bankrupt, you won't lose all your money because it's separated between all these companies. Right? So that's the power of mutual fund. Later on, at the end, I'll show you guys some great mutual funds.
Yeah, I've seen. I think I was a part of a mutual fund for a bunch of different cryptocurrencies. And they held it for a bunch of different ones. So it was like some smaller Bitcoins, some smaller Ethereum stuff.
Yeah,
Very
so
cool.
that would be considered high risk. You know what?
Because it's crypto.
Because it's in a sector.
Yeah.
It's the only sector that mutual fund is invested is in crypto.
Right.
See, it's not really diversified anymore, right?
Right.
So it's diversified in the companies, but not in like what type of companies there is.
Right.
Right. So we're gonna learn about aggressive or conservative. So this is the main question you need to ask yourself. So for us, because we're younger, right, we want to be a little bit more aggressive because we can beat, risk with time. See, no mutual fund ever has like completely gone in bankrupt. They go like this, kind of like a yo-yo, right? So it goes up and down. So when we have a lot of time, we can be a little bit more risky. But if you're older, you want to be more conservative, right? So for us at a younger age, we would be mostly looking at like these type of investments. So like large cap and, balanced funds and like aggressive equity funds, emergency growth fund, and also like small cap would fit in there too. Do you guys know what large and small cap is?
Yeah, so like a large cap could be like, for example, Amazon, like any of the bigger companies. Small cap is more like a smaller
company.
Yeah,
exactly. And then there's emerging markets are like China and those countries that have like those emerging markets that you can invest in as well. Right. And then something very conservative is like income and bond funds. They're very conservative because they have like that almost sort of guarantee. But remember, the less risk, lower reward. Right. Higher the risk, higher the reward. That's why, for example, crypto is very rewarding, but it's super risky. Right? So that's what you got to look in when you're investing and really learning about investing.
That's why I feel like it's such a personal, it's a personal decision, right? It depends on 100%. There's not a one size fits all situation because, you know what, when you're younger, maybe you have more time, right? But even if you have more time, you might not have the funds. When you're older, for example, you might have more funds, but you don't have enough time because you're planning for your retirement. So
it depends on everybody. But usually when we do like a mutual fund application, we always ask about how many years. Right, so there's like a category that pops up, and usually we ask like, okay, how old are you? But typically saying, you are correct, it's different for everybody. But like age-wise, older folks tend to go more like conservative because they're scared to lose all their money.
Right.
Right, and then younger people, they tend to be a little bit more aggressive because they want to, get rewarded more, like invest in crypto and these things. But that is correct. For everybody, it's different, right? So let's talk about the rules of investing. So have you ever heard someone say, I lost money in mutual funds? No, right? And then your next question should be, which rules did you break? Sorry, this is, okay, there. Rule number 1. So this is kind of what we talked about, diversifying to minimize the risk. So I like using this. Like imagine you have one pencil and trying to break it, super easy, but breaking 50 is impossible, right? So this is kind of going towards more mutual funds and why it's important. and why it's less risky. So I'm gonna pull up one here. So I'm just gonna go. I want to show you guys, this thing. So I want to show you guys this. I remember telling you guys about this. So let's say there's two investors, right? Investor A and investor B. Let's say they try to both put in $5,000 a month. A year. But investor A, from age 22 to age 29, they only saved $5,000 a year, right? And then investor B, from age 22 to 29, they did nothing but start contributing from age 30 to age 67, if I'm correct. Who do you think will have more money? So I'll explain it again. So the first one, they only saved from 22 to 29. The other one, they saved from 30 to 67. And let's say they average 9%.
Is that the second investor B is averaging 9%?
Both averaging 9%.
Both are averaging 9%.
Yeah. So the first one is 22 to 29, and then?
So from 22 to 29, he saves $5,000 a year, but then stops at 29.
Okay.
And then the other one, he doesn't save from 22 to 29, but from 30 to 67, he saves $5,000 a year. Who would have more money? It might be a trick question.
But I feel like it's a trick question. It's probably A, but I feel B makes more sense logically.
I feel like.
What do you think, Carla?
I feel like I'm being duped. I don't know. I want to say investor A as well.
Okay. Well, you could be wrong. I might just be a trick question.
Right.
Hunyah, what do you think?
I would say I think investor A because he started early. So definitely the one that started at 22.
So let's take a look here, guys. So take a look at this. So investor A doesn't stops age 29. And look at how the compound it works, right? So investor A put in a total of $40,000. At age 67, he would have $1.8 million, right? And investor B start from 30 to 67, $5,000 a year, and put in $190,000, but only has 1.7.
Mm-hmm.
So what do you guys think about that?
Well, he's not too far behind. That's what's interesting about it to me, right?
But look at how much he put in.
Right.
That's what you got to think. And at that time, it's very hard for you to save money because you have a lot of responsibility.
Yeah.
Right? So this is why it's so important for us to save money while we're younger. But do you guys have any questions about that?
I think that's spot on for me. I think it's a good thing to gauge and think about saving money from ages 22 to.
Yeah, well, it doesn't matter what age you are. The thing is, you should start saving money.
Start as early as you can.
You can.
Yes,
don't wait.
Yes. Yeah.
Right. So
cool.
I will show you guys some funds that have been averaging 12%, and then maybe you guys can look into that. So I'm gonna pull it up here. Give me 1 second. Do you guys have any questions about the presentation?
I think we can get into some in a bit.
It's been interesting so far.
Yeah.
I have a couple questions, I guess, just to kick it off.
Sure. Let me just pull this up first, and then we'll go into questions. Okay. Just gonna share my screen. So obviously you need to be licensed to sell this. I am licensed, but for you guys, I can't help you because I'm in Alberta, but you guys can talk to somebody and look at your stuff before, right? So my thing is, don't get ripped off by somebody. Always when they try to, sell you an investment or sell you something, make sure you look at it and see what it is, right? So this is one of the companies that we work with. They're called Fidelity Investments. Have you guys heard of that or seen it?
Yeah.
I don't think I have.
Okay, so Fidelity Investments is actually one of the largest investment firms in the United States. They manage about, if I'm correct, $2 trillion, right? Around $2 trillion. Not billion, trillion. It's crazy, right? And this is a mutual fund. It's called Fidelity Canadian Growth Company Fund. So this is one that I give to some of my clients, right? It started in 1994. Carlo, you were born in 1994?
I was born in 96.
Oh,
yeah. Not that old.
Not that old. Okay. So since 1994 to today, October 4th to yesterday, the average rate of return is, look at that, 11.8%.
Wow. Yeah.
Right.
Yeah.
And this is a medium, so it's not aggressive. Right. So back in 1994, if you guys were alive back around there, anybody watching, if you put $10,000 here, right now you would have $212,000. Right. So this is a really great mutual fund. And one more thing, when you go into a mutual fund, most people at the bank, they would say, oh, you know, if you go to a private investment, they have a higher MER. Do you guys know what an MER is?
No.
Okay, MER is management expense ratio. So that's how the managers and the advisors and everybody gets paid.
Are paid, right?
Yeah, right. Because when you invest, they don't actually take money from you. They take money from the growth, the interest rate.
And is that there on the middle left part of the screen?
Right here.
6%?
Correct. Okay. So what that means is you go at 11.88 and you add 2.26.
Oh, you add 2. Okay.
Yeah. So you add. So it's actually been doing 13%.
Okay.
Right? The 11.88 is what you get, and then the 2% is what the advisors, the brokers, and everybody gets.
Okay, so they just can't show it because that's what they're deducting from.
Correct.
I think I'm understanding. Okay, great. Okay.
Right? Does that make sense?
Yeah.
So the next question, when you got to look into a mutual fund or investment, you got to look at what type of companies are in here. Right? So if you go down here, this is mostly Canadian companies, right? So here are some of the top companies in this investment. Do you guys know this one?
Yeah, Toronto Dominion Bank. Yeah. TD. Manulife, of course. Yeah.
Mm-hmm.
Wells Fargo. Now, is this in then Canadian? Just a quick question. Canadian dollars?
Mostly Canadian, right? Yes, okay. Canadian dollars.
Canadian dollars. Okay.
Yep. So there's about 155 companies in here. So, for example, let's say you guys put $100 here, right? Mm-hmm. $100 would be split between all of these companies.
Right.
Right? That's what makes it less risky. And what it's up against is actually the S&P 500, the S&P and then the TSX, right? So it's a Toronto one. And then it shows you what it's been averaging every year, right? See, last year it did 45% in 1 year. Crazy, eh? And then do you guys remember like 2008 when everybody's like, oh, the stock market's collapsing and stuff like that?
I remember that.
Yeah, so that was around this time right here. The market actually did really good in Canada.
Yeah, that was, I think that was like, it was like, I forgot the word. I'm not sure if it's not repression. It's like something else that was in there. Like it was like for a short term. It happened in the U.S. markets as well.
Yeah, the housing bubble.
Yeah, I forgot the exact.
They did the movie on it. The Big Short.
Big Short, yeah, great movie.
There we go.
So another thing that you can look into is a lot of the time, because we can't tell the future, but we can tell what happens from the past will most likely happen in the future too, because history has like a constant like growth like that. It like has a really similarity, right? So how can you guys take advantage to do this, right? Is the question that you should have. So for example, if you guys just saved $100 here, since how long is that? Like 25 years, right? Right. If you guys save $100 a month for the next 25 years here, you guys would have $194,000 just saving $100 a month, right? Obviously, if you increase your savings more,
that would increase. Yeah,
exactly. For example, now,
I just wanted to ask quickly, can you put in at any time? You can put into this mutual fund.
Correct.
And what about withdrawing that? How does
that? So withdrawing that, it depends on the broker that you're with and what type of There's what's called front end, and there's called DSC.
Mhm.
DSC is that you, as long as you don't withdraw for the first 7 years, you don't pay a fee, right? But if you withdraw, you pay like a small percentage. But every year you can withdraw 10%. And then front end, the broker can charge you from 0 to 5%, but it depends on the broker, obviously, right? Mostly what I do for most of my clients long term is usually DSC because most of them don't touch their money for the next couple of years, right? So it's not locked in. You can always withdraw it, right? But it has that small fee there that charges. Okay. So do you guys have any more questions about this?
I mean, so how would one get started on it then, essentially, if they wanted to invest in something like this today?
So what I would say, Carlo, is to talk to some like investment firms and then ask them all to give you like a brochure, right? And then take a look and study like kind of what I said. Like, okay, show me what type of fund. If I was going to invest with you, show me your fees, show me what type of funds you would invest me with. Take that. Don't ever rush into things, right? So take that and then study it and see, okay, this is because in a mutual fund, you can see how it's done for the last 10 years. And in the last 10 years, if it's been bad, guess what? You don't want to save your money there.
Right.
Right. So yeah, I think there's a lot of good companies out there. Go looking for brokers that sell Fidelity. Right. And then
you need to go through a broker to go into this. Okay. Because I know with things like Wealthsimple and you're getting into the stock market, you don't need to. You can kind of just handle everything yourself, which is super convenient.
But the thing is, there's nobody managing your money. See, the great thing about a mutual fund is you get a manager. For example, Mark Schmel, he's probably the best portfolio manager in Canada.
Okay.
Right? So he has a team that studies the investment pretty much every day and studies the companies.
Right.
Right? So that's what makes the difference between doing it yourself and using mutual fund. And it says, I think the average day trader, about 90% of day traders don't make money. Only about the 10% do. That's like the stats that they came up with, right? Because it's very hard to day trade and to know the graphs.
You always see the 10% though online who are like, yeah, I just made 20,000 in the last hour by sitting,
Yeah, that's guys, that's crap. I think we all know there's like those guys are trying to sell you something like a course.
Of course.
And then they're gonna make more money doing that.
Yeah.
Because think about it. If they were a day trader making millions of dollars, why would they start running ads to tell you to do it with them?
But why would they want to share this top secret information?
Exactly, right? So it's stupid. Anybody who tries to sell you information saying that they can make you rich, that's you got to take a look at that and see.
I mean, have any of you ever tried day trading?
No, my brother has though.
Yeah,
my brother did that and he lost. He made some money, but then he ended up losing all of it too.
Right, because I feel like it's such a risk. That's that high risk, high reward scenario that we were talking about, right? Where it's kind of like, when AMC was doing its thing a little while ago, right? It would go super high and then it would come back down and be super, super low. So you're kind of wanting to take out your money there when it's at that high and run with it, right?
Yeah, and you got to look at Warren Buffett. I think he's probably the best investor there is. He never day trades. He always holds long term. If you look at Warren Buffett's, you have Yahoo Finance, right? Search up Berkshire Hathaway, right? One stock, do you know how much it is?
300, 200K.
Yeah, 300, 200K. And it works like a mutual fund. So in Berkshire Hathaway is a company that holds multiple companies.
Right. Yeah, no, he's
right.
Incredible.
So he never just like buys and sells and day trades. He's a long-term holder of investments. Did you find that, Carlo?
Yeah, I just found it here.
What is it right now?
So it's Berkshire Hathaway, right? Because I think they took me up. Here we go. Now it's A or B?
It's A.
Okay. It's 418,539.
Just one share.
Yeah.
Right? So that one share has like multiple companies.
Yeah. And it's up almost $6,000 in the afternoon.
Yeah, actually, market's been doing really good.
Really good today. I was gonna say like everything is green actually. So yeah.
Right, so yeah, do you guys have any questions about that? Really?
Go ahead. I was gonna ask, what would be like if you had to give one tip of advice for someone, our age who doesn't know a whole lot, wants to start out, what would you say?
Read the book Finance for Dummies, right? You can learned a lot of information there. One more thing I didn't go into today because I only want to talk about investing. There's also like life insurance. That's also a type of, not really an investment, it's a protection, but a lot of people get ripped off in it, right? There's people that try to sell it to you as investments. So read that book, learn about it, right? Learn about the difference between like in type of investments there are, real estate and everything. And really get educated is what I would say.
Okay, awesome. Yeah, thank you.
Talking about like, can I just ask some stock questions? Like, what are you thinking about, like, stocks? Like, personally, are there some that you're into right now? Some that you're
actually, not into? Right now I have a lot of shares, like almost 1,000 something plus shares in a company called Fobi. Right? Okay. They're pretty much, you can search it up. I got it for $1 a share, but right now they're at like $3 a share. Obviously, I can't like say buy it because it's like
you're not gonna like solicit advice. Just we're just talking, right? Of course,
right. So
is that FOBI?
FOBI, yeah. This company, they're actually doing all like the like the vaccine like data records and all that, like the information. So they're doing all of that, right? So that's a company I had. I had a company called Trill, TRIL, cancer company. They got bought out by Pfizer. I bought it for $9, so it went up to $22. But mostly, guys, I use stock as play money. So I have like $4,000 in there. Yeah. And then I just mess around with it. Most of the money that I save is in my mutual fund because I know long term that can grow. But if I have like an extra $100, $500, I would put it into my stock and just mess around and have fun and learn, right? But if you're gonna do stocks, do it as kind of like a hobby, not like a game plan.
Right, of course.
When you mention stocks, for what I've known, like my brother, he actually started his business from buying stocks, and he was with TD, and then later on he started with them, and now he has like his own business, and he has his own employees, and he's all the time. He still does stocks, but he started from there, and now he's successful in there.
Right, and I'm sure you can get lucky like that if you bought
in
something
like if you're going for long term, that's a good way to start your business. I just thought I add that.
So I'm going to show you guys one thing. This is an investment. I covered the client's name, but this is one of the investment. This client started with me last year. So since last year, they put in a total of $9,990 with me, right? And they grown 15,000 in a year. Right, and this is a mutual fund. And this one's not high risk. I'll show it one second. I'm gonna pull out the interest rate for you guys, so you can see. So yeah, look at this, averaging 41%.
Okay.
Right. Obviously, I'm not gonna say it's gonna happen every time, but this is what and it's the companies I showed you guys: Fidelity Canadian Growth and Fidelity Insights Class.
So you're offering like your knowledge to these clients, and then they hire you to find these mutual funds that are appropriate for their investments.
Correct. So I work with different investment firms like Fidelity, AGS, and stuff like that. And I'm mutual fund licensed. So I sit down with the client. First thing, I kind of sell them an investment plan. I got to do their whole like financial game plan, figure how much debt they're in, do all that, and then figure out how much they need to save to retire. So I can show you an example of like, Carla, if you wanted to retire, I can tell you how much money you need to save. For example, when do you want to retire, Carla?
You can. I don't know.
at what age do you want to stop working?
Like, let's say.
Yeah. No. It's got to be realistic.
The 65 mark, right? 65. I think that's a good age for sure.
So let me pull up an investment calculator here. Just 1 second.
Actually, I have an interesting tip to add in there. So recently I had to do my taxes because turns out the ones from my college and the ones from my college and university, the 2 years after it, I was unable to do my tax return. So this is what happened. So I recently got a letter that says I could still do my tax return, and in there it states in there that it comes in your bursaries, scholarships, and your pensions in there through Canada Revenue Agency. So definitely look into that.
Yeah. So you're 24 right now, Carlo, right?
25.
25. Okay, I was close.
Very close.
Okay, so you have 40 years to go.
That is so strange to think about it like that.
Oh no, this one only allows. I just pull up a random thing. Oh, it only allows 30 years. That's stupid. Okay, let's say you're gonna retire at 55. Okay.
Yeah. Even sooner.
Sooner. Say we average 9%. Carlo, if you most likely don't know this, but if you're retired, how much money do you think you need every month?
Oh, geez. I have no clue.
Couple thousand.
Maybe Jessenia can answer for you.
Like,
how much Jessenia do you think an average person would need when they're retired?
Yeah, a couple of thousand, maybe.
$4,000 a month. It depends on your lifestyle too, obviously.
Four is a lot.
I think four is a lot. Yeah.
It wouldn't be actually a lot. It depends.
If you have if your mortgage is paid off, it depends, right? Like,
yes.
assuming your mortgage is paid off, I'd say 2,000, 2 to 3, maybe.
Yeah, say 3,000, right?
Yeah.
So what I do usually is I do 3,000, and then we times it by 12, so it's $36,000 a year that you need without working, right? So the next question is, how do we figure out how much you need to pull out every month? So the way to do it is you go divide it by 9%. So why did I do 9%? Is because if you had 400,000 and you had a mutual fund that averages 9%, and you withdraw 9%, that's like you're getting $36,000 a year.
Okay.
Does that make sense?
Yeah.
Okay. So I'm gonna go here. Wait. Actually, don't know how to use this one. Sorry, I'm gonna go to a different one real quick.
Yeah, all good. Maybe that one can increase the years on it too.
Yeah, sure. Let's go to the one we have. 1 second. Let's log in here. I know it's a lot of information for you guys to take into.
No, it's all good. This is really interesting stuff to know for a lot of people. I think, to be honest with you too, we could even have a whole other separate talk on just stocks and like, I think maybe some of the meme stuff that was going on. It'd be super interesting to talk about that.
For sure.
What the market's like. Yeah, exactly. Maybe even get into some of the crypto that's coming out nowadays, because it's interesting how more young people are getting involved with this nowadays, right? So
Reddit stocks and everything.
Yeah, Reddit stocks.
Reddit stocks, yeah. So take a look at this, guys. So your duration is going to be 40 years. Oh, that's not what I wanted. Okay, sorry, there you go. So you need 400,000, 40 years, right? 9%, beginning balance 0. So Carlo, at age 65, if you wanted to retire and averaging 9%, all you need to save is $84 a month.
Okay, I can do that.
Right? But like 400,000, I think 36,000, guys, is a little bit like less.
Yeah.
Maybe aim for a little bit more. Let's say like somewhere like 600,000.
Right. But let's say you wanted $1 million, for example.
Let's just say $1 million.
Yeah.
So Carlo, if you wanted $1 million with inflation, right?
Mm-hmm.
You need
it's
to save
doable. Yeah.
$200 a month.
That is very doable.
Mm-hmm.
Right? So look at that, guys. You would totally contribute $101,000, and look at the growth.
The interest. Oh.
Right. But take a look at this. Imagine you just stayed in the bank, not even 3%, 1%, right? Look at that.
Wow.
Right.
Right. Or even 3%.
It completely flips.
right?
Yeah.
You need to save $1,000 a month.
Yeah. That 3% is closer to that like 50-50 with the contributions and interest. So it's really interesting to see.
Yeah. So that's why it's so important that number one, you start early. And number two, you find a good place to invest.
Mutual fund.
Yeah.
Mutual funds. It can be anything as long as you can average a good rate of return, right?
Right. Yeah, this has been fantastic, man. I really appreciate this. I know I've learned a lot for sure. Yeah. Like I said, we should definitely do a talk. I feel like if people are interested in hearing more about, because I feel like we've got some good perspectives here. You know, for me, I have like a little kind of basic knowledge of the stocks and mutual fund stuff. And then to hear from you as more knowledge about it, I'm learning a lot. And yeah, it offers me a fresh perspective on things. I feel like we could have another talk about this. Totally.
Yeah, 100%.
Yeah.
Awesome. Thank you so much, Ravinder. This was great. And yeah, definitely looking forward to, you know, more talks about this in the future.
Yeah, this was really interesting. Like, really learned a lot of new things in there.
We should have classes like this.
We should.
In high schools, I would say even in colleges and stuff, like ones that you could take, right, that are kind of just on investments. So it's
actually funny what I learned, because I had like a mentor. He used to be an accountant before. He actually even taught me how to do taxes, and then I do my parents' tax. I do business tax for my parents, right? But it's crazy. Some people go to accounting to get a degree to learn all that stuff, but it's very simple sometimes to learn the basics and even do your own taxes, right? And I would say go read books that teach you about that. Go learn from like other people, because they can teach you a lot. And to even do your own taxes, that can save you like $200 a year.
Yeah.
Right.
And plus, there isn't much thought about taxes in high schools, I've noticed, even over here. Like that thing you have to learn yourself when you get into college. So that's how
it's actually about it. It's employee tax is very simple. People think it's hard. Employee tax is very simple. Where it gets hard is like business and then self-employed. It's a little bit more complicated. But
yeah, no, the tax I'm taking right now and university is very hard. So.
Yeah, right.
But if you're an employee, it's all you gotta do pretty much is enter your numbers, enter your RSPs and stuff and other basic stuff. And it's very simple. But when you go into business, for example, for me, I have to write off all the stuff I use for business, like my car, my gas, my phone bills, and I pay less taxes because of that. That's the great thing about being a business owner. You pay less tax because of those things, right? So maybe that's one thing we can also talk about too.
Absolutely. I think having the perspective of a business owner, and then, you know, things you can write off, like you said, right?
Yeah.
That would be beneficial for sure. Yeah.
All right, guys. Thanks for joining us today. And
that flew by.
It did. Yeah, it went quick.
Yeah.
All right. Do you guys have anything to say?
Yeah, no, thank you, everyone. And if you would like to leave a comment, remember to follow all the socials from Moksha Canada on Facebook, Twitter, and Instagram. And yeah, thanks for having us here for another talk today. That was super interesting. We're gonna dive deeper into it, I think. So
yeah.
See you guys.
Thank you all. See you on Thursday.
Okay,
bye everyone.